Let's break down the latest cut now with Dr. Victor Oboh, is the Director, Monetary Policy Department at Central Bank of Nigeria, joining me from Abuja studio. Great to have you on the show, sir.
Good afternoon, Laddie.
Fantastic. So I guess it's excitement now, from the MPC side of things and, private sector right here in Nigeria. But talk to me about the expected impact of this 50 basis point cut on the Naira, and how do we really see cheaper credit going forward with this?
Thank you very much, and good afternoon, Nigerians. It's no longer news that the Monetary Policy Committee at its 302nd meeting held 2 days ago with an announcement yesterday cut the MPR by 50 basis points, thereby reducing the MPR from 27.5 to 27%. This decision was taken on the back of prevailing macroeconomic environment, which has improved considerably. As you agree with me, most of the macro indicators have turned green, and not just green, but they are sustained in terms of this green nature of the indicators. Talking about the inflation numbers, the exchange rate, the reserves, even the balance of payment, and the rest of them. So this gives the committee some impetus to once again think that it is high time they considered the issue of economic recovery and to support government effort in improving economic recovery. So that is it. We expect that since there is a cut in the MPR, that should transmit to all other rates, including the retail rates, the prime lending rate, and even the maximum lending rate, so that growth can also be supported to some extent, while at the same time not jeopardizing the issue of protecting low and stable inflation. Thank you.
Also know the relationship between interest rates and the country's currency. So normally, a rate cut normally leads to a weakening of the local currency, and a rate hike normally raises the strength of the currency. So now that we have the first rate cut, is there a risk of the Naira getting weaker, in your opinion?
Oh, not at all, Laddie. Remember that the fundamentals, the macro fundamentals are strong. We are hopeful with the reforms in the exchange rate market that the Naira will continue to strengthen. Remember that the Naira currently is trading below 1,500 per dollar. And the key issues around that, has to do with the availability of foreign exchange, the liquidity at the FX window, which is very, very strong and very high to sustain the demand at that market. As I speak to you, all demands that are legitimate are backed up and they are met at that rate. Now, the premium between the BDC and the official end firm is almost zero. It's very low too, which tells you that this rate, this stability in the exchange rate market, window is sustainable. Much to that is the robust external reserve position that we have that is able to be able to defend in case of any shock. So all this provide the comfort that the slight increase in NPR is not likely to see or lead to any depreciation in the value of the local currency, the Naira.
All right, let's look at another big headline from yesterday. That's for the non-TSA bank deposits. Therefore, the CR of about 75% for those. I'm wondering how the CBN is going to gauge, compliance for this and the expectations, going forward.
It's very clear. What the CBN has just done is to ensure that non-TSA public sector deposits are brought under the CRR regime of 75%. It simply means that all deposits from public sector that are not under the TSA will now be charged 75, percent CRR. They will be sterilized. What that simply means is that CBN is restricting the use of those funds, for trading by banks, because those set of funds, are part of liquidity, extra liquidity injection into the banking system, therefore complicating the management of liquidity by the central bank. So necessary steps will be put in place to ensure that the banks comply with this. And this does not impede the owners of those funds to have access to them as and when due.
All right, so, definitely we have the first cut now. There's also that risk of, stoking inflation again going forward. What are the strategies here to keep inflation in check post this rate cut?
The strategy is this. If you look at what we've just discussed about the CRR on non-TSA public deposits, is going to help in a very significant way in sterilizing liquidity at that level. So that is going to bring down the level of liquidity that will be inflationary. That is on the one side. The other side is that the tweaking we have done to the corridor will be helpful in encouraging interbank trading. And if that interbank transaction is strengthened, it's going to help to improve monetary policy transmission. That is on the other side. There are also some very good factors that give us an impetus for positive outlook in terms of inflation. Remember that we are approaching the onset of the harvest season, which simply means that the prices of food items, which constitute a major proportion of the CPI basket, those prices will continue to downtrend. And that is going to help us to sustain the pace of disinflation that we have. But much more importantly is the impact of the stable exchange rate. So in that aspect, that is going to stem the rate or the transmission of imported inflation into the local economy. So with all this, we are very, very optimistic that the inflation will continue to decelerate.
All right, definitely I share that optimism too, and hopefully maybe at the next rate-setting meeting, maybe we get a 100 basis point cut next. Hopefully we'll keep watching out for that and keeping our eyes on inflation and the currency. Thank you so much, Dr. Victor Oboh is the Director, Monetary Policy Committee Department at the Central Bank of Nigeria. Thank you for coming on today.